All right, let's do this. Time to unlock some serious investing knowledge. We're diving deep into The Intelligent Investor by Benjamin Graham. It's basically the Bible of value investing, and even Warren Buffett swears by it. We're not just hunting for hot stock tips here, though, right? It's bigger than that. We're talking about building that investor mindset, the kind that wins in the long game.
You hit the nail on the head. It's remarkable how relevant Graham's ideas still are. I mean, think about it. His book came out in 1949. But his focus on value investing, unearthing those undervalued assets with serious long-term potential, that's timeless.
So less about those quick wins, more about spotting the hidden treasures the market's overlooking. I like the sound of that.
Exactly. And it all boils down to understanding this concept of intrinsic value. Okay, imagine you stumble on like a vintage watch at a flea market, right? Seller wants $50 for it, but you know your stuff. You can tell it's a rare model worth way more than that.
Ah, okay. I see where you're going with this. The watch is real value. It's intrinsic value. It's way higher than its price tag.
Boom. You got it. And that's what we're doing in the stock market. We're looking for those companies, the ones whose stock price doesn't match their true worth. You got to look at their financials, their business model, all that.
It's like detective work then. Digging deeper to uncover the real value everyone else is missing.
Love that analogy. And that focus on intrinsic value, that's what sets Graham's approach apart from just, speculating.
Yeah, which can be tempting, especially these days. So much buzz, everyone's chasing the next big thing. Yeah.
Oh, absolutely. It's everywhere. But that's exactly where Graham's margin of safety comes in. He had this great analogy. He compared it to, picture this, driving a truck. This truck weighs 9.9 tons, and you're about to cross a bridge built to hold 10. You feeling safe?
No way. I'd want a much stronger bridge, way more buffer.
Exactly. You want that cushion, that extra room for error.
Yeah.
And in investing, that's what margin of safety is. It's buying below the intrinsic value, protecting yourself if things don't go perfectly as planned.
So even when you're feeling good about a company, gotta stay cautious, factor in that buffer.
Precisely. It's acknowledging you can't predict everything.
This is making a lot of sense. But I gotta ask, does this whole long-term, value-focused approach, does it seem a little outdated? I mean, the markets are moving so fast these days.
That's a really common thought, yeah. But look at Warren Buffett, one of the most successful investors ever, right? He built his empire using Graham's principles.
So these old-school ideas, they're still the key to success even now. That's pretty encouraging.
You bet. It's about tuning out all that noise, all the hype, and focusing on what truly matters, those solid fundamentals.
Okay, so we've got this foundation, intrinsic value, margin of safety, got it. But how do we actually use this stuff in today's market? Where do we even begin?
Well, Graham, he was all about research, really digging deep. He believed that you should never just rely on rumors or follow the crowd.
So no blindly jumping on the latest social media stock tip, huh?
No way. Nope. You got to roll up your sleeves, dive into those financial statements, really grasp the business model, figure out if they have what it takes to grow, to generate those earnings long term.
Sounds like a ton of homework.
Yeah, it can be a bit daunting at first. But don't worry, we'll dive into some tips and resources to make that research a bit easier in the next part of our deep dive.
Perfect. Can't wait. Before we go there, though, let's talk about diversification. I know it's important, but just to be sure, can you remind us why?
Absolutely. It's that classic saying, don't put all your eggs in one basket. Diversification, spreading your investments across different companies, industries, even different types of assets. It's all about managing that risk.
So if one of your picks doesn't do so well, the others can pick up the slack, right?
Exactly. And the cool thing is we have some great tools to make diversification much easier than back in Graham's day.
No more excuses then, huh?
No more excuses. Things like ETFs and mutual funds, they let you invest in a bunch of stocks at once. Boom, instant diversification.
Right. Makes it a lot more accessible. All right, before we move on, there's something else we got to talk about, something a lot of investors, including myself, struggle with emotions. How do we stay calm, make rational decisions when the market's going crazy?
That's such a great question, and Graham knew this. He wrote about it. Fear and greed, those are powerful forces, and they can lead to impulsive decisions, the kind that end up hurting your returns.
So not letting those emotions cloud our judgment, essentially.
Exactly, and having a solid investment plan can help with that. Write it down, stick to it, don't let the market's mood swings control your actions.
Solid advice. But with all this tech now, robo-advisors, algorithms that analyze tons of data, do Graham's principles still matter? Can't tech just do all the heavy lifting for us?
That's a fascinating question. One we'll definitely explore in the next part of our deep dive.
All right, listeners, stick around. We'll be right back to dig deeper into The Intelligent Investor. We'll be unpacking how these timeless principles can help you navigate this crazy world of investing.
It's going to be good. So you're asking about technology, right? Whether it's kind of made Graham's ideas obsolete?
Yeah, exactly. I mean, think about it. We've got robo-advisors, super sophisticated algorithms, endless data. It's easy to think, hey, maybe I don't need to do all that research myself anymore.
And that's where the trap lies, you know? These tools can be helpful, for sure. But they shouldn't replace that fundamental understanding, you know what I mean? It's like using GPS without knowing how to read a map. Sure, you might get to your destination, but you won't truly understand the journey, the why behind it.
So still got to be in the driver's seat, even with all this tech as our co-pilot. Right.
Absolutely. That's where Graham's principles are still so powerful. They give you that framework, that ability to understand what those algorithms are doing, to question them, not just blindly trusting the recommendations.
So it's all about using tech intelligently, but with that solid foundation of knowledge backing it up.
Exactly. Leverage the tools, streamline your research, find potential investments, even automate some things, but never just blindly trust a black box. You know what I mean?
Gotcha. Makes total sense. Now, Graham also talked about this difference between investing and speculating, right? Can you break that down for us?
Oh, that's a key distinction for sure. According to Graham, an investor, they analyze the company inside and out. They're looking at long-term prospects, aiming for that steady, sustainable growth. A speculator, on the other hand, they're more focused on those short-term price movements, trying to time the market, betting on those ups and downs instead of the actual value of the asset.
So it's like planting a tree, nurturing it, watching it grow into something strong, versus, I don't know, betting on which way the wind's going to blow today.
Perfect analogy. And listen, speculation isn't always bad. It has its place. But the trouble starts when people confuse it with investing.
Right. When you're treating a gamble like a long-term strategy, that's when things can go wrong.
Exactly. And that's where those classic investment mistakes come in, the ones Graham warned about. Chasing trends, forgetting about that margin of safety, letting emotions take over.
Speaking of mistakes, that section in The Intelligent Investor, the one about common pitfalls, it was really eye-opening, felt so relevant to what's happening right now.
It absolutely is. Graham talked about overreacting to volatility, getting caught up in fads, letting emotions make decisions for you. These are challenges every investor faces, no matter the time period.
So let's break down some of these mistakes. First up, overreacting to market volatility. It seems like every day the market's either soaring or crashing. It's exhausting. How do we stay focused with all that noise?
That's where Graham's long-term perspective is so valuable. He reminded investors that, in the short term, the market acts like a voting machine, driven by sentiment, speculation, often irrational behavior. But in the long term, it becomes a weighing machine, reflecting the true value of those businesses.
Okay, so don't sweat the daily ups and downs, zoom out, focus on the big picture.
Exactly. Your strategy shouldn't be dictated by headlines or those sudden market panics. Remember, you're buying a piece of a business, and if the fundamentals are strong, short-term swings shouldn't derail you.
All right, that's reassuring.
Yeah.
What about chasing trends and fads? We've seen it time and time again, the dot-com bubble, meme stocks, the crypto craziness. What's the big risk there?
The risk is mistaking speculation for investment. That's the big one.
Jumping on the bandwagon without really understanding what you're buying into.
Yeah, and that can lead to some pretty bad outcomes. Trends, they come and go. What goes up fast can come crashing down even faster, you know?
So how do we avoid getting caught up in that hype, especially when it seems like everyone's making quick money?
Stick to what you know, what you understand. That's key.
Do your research before you put any money down.
Absolutely. Thorough research is crucial. And most importantly, don't let FOMO, that fear of missing out, control your decisions.
It's like those get-rich-quick schemes, right?
Yeah.
Sounds too good to be true. Probably is.
Exactly. Now, another mistake, ignoring the margin of safety. This one's especially tricky in those bull markets when everything's going up. Easy to get swept up in the excitement.
Yeah, that's when it's hardest to be cautious.
But that's exactly when it's most crucial. Remember that margin of safety. It's your protection against unexpected events, mistakes, downturns. Being conservative, even when everyone else is feeling bullish.
So it's almost about being contrarian then, going against the crowd, not following blindly.
In a way, yeah. Think independently, do your own research, don't let the herd mentality dictate your choices.
Makes sense. Now, last mistake, letting emotions drive those decisions. This one feels tough. Investing is tied to our hopes, our fears, our financial well-being. How do we detach ourselves emotionally?
It's definitely challenging, no doubt. Graham understood that we're emotional creatures prone to fear and greed, and those emotions can lead to impulsive actions, the kind that hurt your returns. It starts with recognizing that the market isn't a reflection of you, your worth.
So a bad trade doesn't mean I'm a failure. A winning streak doesn't mean I'm a genius.
Precisely. Detach your ego from those market swings, have a plan, write it down, stick to it. That helps avoid those impulsive moves.
And remember why we're investing in the first place, right? Our goals, the long game.
Exactly. Retirement, a down payment, your kid's education, keep your eye on the prize helps you weather those inevitable storms.
This has been so insightful. But I'm wondering, are Graham's principles really still applicable today? A market's so different. New technologies, new assets, new ways of investing.
That's a fantastic question, and it's one we'll tackle in the final part of our deep dive, so stay with us.
Welcome back to the deep dive, everyone. We've been exploring Benjamin Graham's The Intelligent Investor. Wow, my brain is buzzing. It's like a whole new way of looking at investing.
That's great to hear. It really is amazing, isn't it, how these principles written so long ago are still so relevant.
Right. But I got to be honest, I'm still trying to wrap my head around how it all applies to, well, the newer stuff. You know, cryptocurrencies, NFTs, even the metaverse. Did Graham ever talk about any of that?
Well, he didn't mention those specifically, obviously. They didn't exactly exist back then, but his framework, his way of thinking, it gives us the tools to approach any investment.
So even with Bitcoin, for example, we can still ask those same fundamental questions. Like, what's driving the price? Is there real value there, or is it all just hype?
Exactly. It always comes back to that critical thinking. With any investment, whether it's a traditional stock or something like Bitcoin, you got to ask yourself, what's really going on here?
So looking at earnings, assets, growth potential, all that stuff, even if it's a brand new type of asset.
Precisely.
Yeah.
And if those answers aren't clear, if the value is just based on, well, maybe someone else will pay more later, then it might be more speculation than a solid investment.
Separating the hype from reality, that's the key.
Absolutely. And that's where emotional discipline becomes even more important. I mean, think about it. Today, we're bombarded with information, opinions, all those get-rich-quick stories online. It's easy to get swept up in it all.
Yeah, no kidding. So sticking to our plan, doing our own research, not letting FOMO push us into something we don't understand.
Exactly. Graham's principles, they're like an anchor, keeping us grounded, focused on the long term, seeking that real value.
This deep dive has been so insightful. Thank you. As we wrap up, what's the one thing you want our listeners to take away from all this?
I'd say it's this. While the investment world has changed a lot since Graham's time, the principles of sound investing, they haven't changed. Seek value, understand that margin of safety, stay disciplined. Anyone can navigate the market with confidence, even in today's crazy world.
And maybe even beat those fancy algorithms while they're at it.
You got it. It's easy to get caught up in the tech, but in the end, it's the human mind, armed with the right knowledge and principles. That's what makes the best decisions.
Love it. So to all our listeners out there, whether you're just starting out or you're a seasoned investor, pick up a copy of The Intelligent Investor. It might just be the smartest investment you ever make. Thanks for joining us on The Deep Dive.